Welcome to Financially Speaking, I'm Shaun Latter. Now, if you tuned in for the last show, you would recall we started our discussion on business assurance and focused on buy and sell agreements, loan account cover and contingent liability. Tonight, we turn our attention to key person assurance as well as preferred and deferred compensation plans. Where the last show focused predominantly on the risk of losing an owner or partner, the mechanisms we'll be discussing in the next half an hour will cover that of the employee. Joining me in studio to discuss the topic of business assurance is Raylan Dunbar, Financial Advisor at FinLogic, and Michelle Human, Legal Marketing Advisor at Liberty. Firstly, ladies, good evening. I'm looking forward to the discussion that we're hopefully going to complete on today that we didn't get to last time. Before we get to that, let's take a quick look at a viewer's question that we received for this week. It comes from Graham in Isando. My financial manager is crucial to the success of my business. What insurance structures and incentives can I implement to encourage her to stay with the company? Now, certainly this flies right into the topic that we're going to have tonight, looking at key person assurance as well as those compensation type plans. Michelle, your response to that, what would it be?
In the good old days, Shaun, we had something called deferred compensation plans. Now, I say in the good old days because it's kind of become something sort of prehistoric as such. It's not something that's used on a regular basis these days, and simply because the tax effectiveness of that type of structure is just not what it used to be. For example, we used to get 30,000 Rand tax-free on maturity for those types of plans. Now, 30,000 tax-free 20 years ago was a lot of money. These days, it's just not going to retain a key employee who's earning an absolute fortune. So these days, we move more into the realm of preferred compensation schemes. It's effectively also a savings plan or an investment plan which builds up a cash value or a maturity value for the employee once they've stayed with the employer for a certain period of time. Sure. And then obviously there is that reward to pay out. Michelle,
obviously, I mean, when we're looking at that, we've got the preferred, we've got the deferred compensation. That's a great mechanism to retain staff, but obviously that's not protecting us against potential disaster management.
In addition to what was just being mentioned, your deferred compensation was ideally set up for people that were going until retirement age and staying with a specific company. Now, as we know, most people change jobs every few years. So deferred compensation is becoming quite old in terms of how it's actually been looked at. The preferred compensation, on the other hand, can be something for a shorter term, right from a 5-year onwards. And that way, it's a nice way to retain staff for a shorter period of time and give them that incentives to be able to stay on after that period. In addition to that, what needs to be considered is Graham should also look at adding in key person insurance for this individual. The problem is, if that person is so important to the business, you need to be able to have capital that will come back into the business in order, if anything happens to her in terms of a death or a disability, so that she will be able to be in a position that, well, the company will be in a position that it's got the cash to be able to either get another employee in, train them up, get them up to the same standard to be able to continue with that business. So there are a few key areas to look at. Key person is obviously more specifically for the actual company to benefit. But in terms of the preferred compensation, that would be better to actually retain the employee.
Yeah. Okay, so now we've picked up 3 areas, the preferred, deferred, and now key person assurance. But let's take a step back quickly, because we spoke and we picked up on deferred compensation. There was a lot of benefit to it perhaps 10, 15 or even 20 years ago. There's not so much now. But I'm sure there's a lot of staff members sitting out there with this type of plan. What do they do? What are their options?
Shaun, I think at this point in time, the important thing for them to realize is that they could be sitting on quite a valuable asset. If those employees have been with a company for 10, 15, 20 years, that cash value has built up over time. So they mustn't just walk away and say, well, this is worth nothing now to me, and just can the entire scheme. What they need to do is sit down with a financial advisor who can say, okay, you know, this is the value that we're looking at, these are the options, these are the tax implications, etc., and be able to work out a structure for them, because they're still sitting with a valuable asset. It might not be as tax efficient as it was, but they're still sitting with something that can be structured within their financial planning portfolio.
Is this something that they keep with their company, or should they be trying to take it over in their own rights as an individual?
It's ultimately going to come down to the service agreement that they've signed, because the service agreement that regulates the relationship between the employer and the employee is of vital importance with the deferred compensation plan. So if the service agreement allows them to take that over into their own personal names at this point in time, that could well be an option.
Okay. Implications thereof? I mean, certainly from a cessionary point of view, there should be something from a tax
From a tax perspective, yes, CGT is a concern, because remember that with CGT, the minute the proceeds do not pay to the original beneficial owner, which in this case is actually going to be the company, it could be deemed to be a second-hand policy, and then you're going to have capital gains tax. But those are all things that they would need to consider in weighing up what is the best solution for them.
There's also a bit of an exemption really for people who have deferred compensation policies and possibly leave a company. Now, if they leave the company can actually cede that policy back to them. And if it was structured as a properly correct Section 11W conforming policy, which means it was correctly tax deducted and that type of thing, you actually get it back in your own name without estate duty and without capital gains tax. It's one of the exemptions that's allowed. But the conforming section has to be 100% in place in order for this to actually be applied.
Which once again just kind of reiterates, you need to see a financial advisor to assess how is that policy structured. Is it conforming, in which case Raylan's correct, you know, you then might have the exemption that you can use. If it's not conforming, well then you're going to sit with a CGT implication.
Well, let's talk conforming, non-conforming now, because that's going to be a common thread that's going to go through all three of these topics. I mean, how does one go about getting a conforming policy in place?
Well, a conforming policy really is set up as soon as a company owns a policy. So in any sort of situation where a company is an owner and then you've got a life assured as an employee or a director or a manager, for example, you're in a position where it immediately becomes conforming. Now, what the insurance companies actually do is that they actually set it up and you can change it into a non-conforming policy. And the way they do that is really just putting a clause into their policy documents to say that they allow multiple lives assured to actually be added onto the plan. Because that actually contravenes Section 11W, which deals with conforming and non-conforming.
Right.
But just to go back to basics, conforming policies really mean that the premiums are tax deductible, and then obviously your proceeds will be taxed at the actual tax rate. Whereas a non-conforming policy, you're not getting the upfront tax break on your premiums, but at least the proceeds come out tax-free. And we find very often that the non-conforming option is usually the better option to go for.
But surely if I'm putting something in here, I want to get a guaranteed tax advantage. So if I'm going to get a guaranteed tax advantage on my premium as opposed to a potential loss of employee, surely that's an attractive option?
I think, Shaun, you also have to compare the liquidity of the company and their ability to pay those premiums at this point in time. For some companies, the tax break is the difference between being able to afford the policy and not being able to. For others, it's not so much of an issue. And I always say you need to weigh up a tax deduction on, for example, a 500 Rand a month premium versus paying tax at the company tax rate on a 5 million Rand proceeds. And you need to weigh up which is better for your company. Now, if you are going for the option where you're going to get a tax deduction now, but then later on you're going to have a tax implication, you can always up your sum assured to make sure that the insurance company is going to pay out enough to not only cover the tax, but also to give you the shortfall as well. So that's one way to kind of compensate for the tax implication. And then when making that decision, as Raylan mentioned, you also need to take into account the CGT. If you ever want to cede that policy back to the life assured, conforming is obviously going to be the better route to go. So there are so many factors that you have to take into account.
There's one more restriction in that as well, is that a conforming policy can only be a maximum of 10% of an employee's income. Now, again, by boosting up the amount to actually be able to cover for the extra tax amount, you could very possibly be going over that actual deductible portion, and then again your premium is not tax deductible. So it really needs to be discussed correctly with a financial advisor who understands the differences to really be able to set up the right structure for a company or for an individual person.
And I think one of the important things is the Act very clearly says if the policy was tax deductible, then the proceeds will be taxed in the hands of the company. It doesn't mean to say if you took advantage of those tax deductions or not. So someone might be sitting with a conforming policy,
not even
realizing it, not taking advantage of the tax deductible nature of it. Suddenly, if in the event of something, it gets paid out and they're going to get taxed again.
And that's a huge issue we come across in the industry. I mean, very often, especially the older policies that were set up, very often they were set up as conforming just because there was a company owner as such on the policy. But the policy actually has been treated as a non-conforming policy. And the problem is that a lot of people think, well, if I didn't take the tax break, I don't have to pay tax on the proceeds. And unfortunately, it doesn't work like that. If it's a conforming policy, regardless of whether you took the tax deduction, you're going to pay tax on the proceeds.
Okay. Let's talk preferred compensation now. I mean, deferred, for all intents and purposes, is not very attractive for most people. Preferred, perhaps something that's a bit better suited for employees of this day and age. How is it different to the deferred comp?
There are some fundamental differences, Shaun, and I think these days preferred compensation is gaining popularity as people start to understand the structures a little bit better. Now, your deferred compensation, very simply put, was a policy owned by the company. On my life, there would be a certain amount going into the investment portion, and if I stayed with the company for a certain period of time, the policy would mature, the company would then pay the money across to me. With a preferred compensation, it's far more flexible. And what happens there is that I, as the individual, take out the policy and I do a collateral cession to the employer to say that I will stay with them for a certain period of time. They then give me a salary increase so that I can actually fund the premium. What happens then is when I have reached that period of time, they cancel the collateral cession. And now the policy is mine to do with what I like. So there's been no change in ownership, and therefore there's no CGT implication.
And then there's just a really thing of saying, well, stay with me for 5, 7, 10 years, whatever the case may be, and you can be, like you said, a bit more flexible in your arrangement. One of the things that I've seen often stands in the way of its popularity is really on saying, well, if I'm going to get that income increase, it's taken as almost like a fringe benefit in my income. It pushes my tax rate up. That's something that's obviously going to have to be picked up if you wanted to succeed really well with an employee. To cover that tax liability or extra tax burden.
Any increase in your actual income obviously pushes up the tax brackets. Now, again, it would have to be really discussed properly with an advisor to see where you are in terms of your tax brackets. You don't necessarily want to be just pushed over the cusp into the next tax bracket and suddenly there's a huge fringe benefit amount. But the advantage of paying a small amount of fringe benefit tax on the premium is actually better because the proceeds will come out to you tax-free. So there's again a give and take sort of situation. And if people really understand it properly and realize what the implications and what the benefits are for them, and again participating in the market, getting good growth in the market, you can have quite a substantial amount coming out to you after a 5-year period. And especially if you've set it up as an endowment policy, for example, you're in a position where the proceeds come out to you tax-free, and a person sitting perhaps at a 40% tax bracket is actually gaining because an endowment plan is only taxed at 30% within the fund.
Certainly a lot to take in from that point of view. I want to pick up on this discussion in the second half of the show. We're going to take a short commercial break, but when Financially Speaking returns, we'll pick up on our discussion on business assurance and how to go about protecting your business in the event of losing a key person.